Hello and welcome to That Investing Podcast. No idea what episode this is, but it's just Charlie and myself today, and we are going to talk about the FTSE 100, what's been happening this week, what's happening next week, some losers, some winners, some are coming in, some are coming out, and will the FTSE 100 deliver stronger returns than the S&P 500? Big question, but welcome, Charlie, to the podcast again, ever favourable co-host and stock analyst at large. How are you?
I'm doing very well, Simon. It's been a wonderful day. We actually had a bit of sunshine yesterday, so got to get down to the beach, and now it's back to work.
Wow.
Wow, indeed.
Of course. How far are you from the beach then?
We're in Exeter, but kind of close to Exmouth on that side, so a good 15 minutes, and then, we're there, which is a nice time to be. But
living the dream.
Well, sort of. I mean, the whole point of living down in Devon is we got the beach and the outdoors, and it's been pouring with rain the entire summer. And then the other 9 months of the year, there's nothing to do. So, train up to London every so often, keep things fresh.
Well, I looked outside at 8:30 last night, and it was dark. And I'm thinking, what?
Dark?
8:30? Where's
Already?
the sun gone? Yeah.
I was on a bike ride a couple of days ago, and in my head, it's still light till kind of like 11:30 at night, which obviously it isn't. So I left at at 8:15 even, and I was thinking, I'll go for a couple of hours, I'll be back by 10:15, it'll be bright light and whatever. And then didn't bother to charge my light, so I was cycling along this canal towpath and this pitch black and rock. Yeah, not fun. But
that could have been
game.
That could have been disastrous, but
could have gone for a lovely swim afterwards, just in case.
All right. Well, glad you made it. Glad you made it back safely, Charlie. So, this podcast episode, we're kind of doubling down on the FTSE 100. We're very, very interested in what's been happening. Charlie, what has been happening? Because you do a weekly roundup, don't you? And
indeed,
you kind of talk about what's been going on, movers, shakers, winners, losers, all that kind of thing. What have you seen actually this last week that's been catching your eye?
Well, there's a couple of things. We're coming towards the end of earnings season, so you've got a couple of defensive stocks next week, Imperial Brands and National Grid, but that nobody's really interested in those, to be honest. They don't tend to throw up any curveballs. The key things that we've had reported in the past couple of weeks, you had Aviva and Legal & General, which are the two big general insurers in the UK, reported back numbers and with mixed results. And then we also have the quarterly review, the FTSE 100, and the important news there is that Persimmon, which is the largest house builder in the UK, it's indicative results, so we're not 100% guaranteed, but it's very likely that Persimmon is going to get downgraded to the FTSE 250, while Marks and Spencer, which is being run really well and is up 80% this year so far, is getting re-promoted back into the FTSE 100.
Did you say that's not a given, though? It's not a given that
not a given, no.
Yeah.
So FTSE Russell do quarterly reviews as a quarterly every 3 months, and they give an indicative idea of which stocks are going to go up and down a week or two before they actually do. The reason they do this is to prevent volatility, because what tends to happen, for example, say you're Marks and Spencer, a clever trader might think, okay, Marks and Spencer, when it goes into the FTSE 100, will get an automatic share price boost because plenty of passive dividend investors who just buy FTSE 100 index trackers, which is a really popular strategy for a variety of reasons, they will then automatically be buying Marks and Spencer shares. And that's not just retail investors, that's institutional investors as well. So when you enter an index, not only is your market cap already grown, to qualify for the index, you also jump up. So when FTSE Russell do the quarterly review, what they do is they give you an indication of what's likely to happen. And therefore, you smooth out those investors kind of jumping into the stock over a couple of weeks rather than there being an overnight push. Which kind of, because what tends to happen if you were to do that is kind of like if you have, like NVIDIA's results yesterday night, where you have a really big earnings beat and then the share price rockets higher. At quarterly reviews, a similar thing could happen, but the share price would rise not based on the merits of the company, but just because of an index inclusion, which isn't good for the stock market in general.
Is it like going from the Championship to the Premier League?
Yes, I would say it's very, very similar. It's similar in many ways in terms of you're getting promoted. You'll have a lot more people will be interested in you. You can make a lot more money as a general rule. And it's just prestige. And I think beyond that as well, specifically with FTSE 100 companies, there are a large number of investors, not me, but there are a large number of investors who won't even consider a FTSE 250 stock or lower for their portfolio when they're going after dividends.
Right, okay.
So in the same way as if you're looking for an employee, some employers will require you to have a degree, right, an undergraduate degree.
Yeah.
It doesn't mean necessarily that you're going to be a better employee, but there are going to be some employers who, if you don't have a degree on your CV, won't consider you.
Yeah.
So when you get promoted to the FTSE 100, it doesn't mean that you're magically a better company, but you're going to be included in far more passive investment because you're part of that larger index, and you're also, as an individual company, going to be looked at far more by people looking to buy companies in the FTSE 100. And then on top of that, index changes tend to be big news every quarter. Not some companies, so Dechra Pharmaceuticals, for example, which is kind of on the cusp of the FTSE 100, seems to drop in and out of it quite regularly. So that's not really big news. Whereas when a company like Marks & Spencer jumps up, and it's been out for a few years now, it is big news because it signifies that it's likely to go higher because of good management. Simultaneously, Persimmon, which is almost certainly going to get downgraded. This I wouldn't say it's particularly Persimmon's fault. It's the fact that house prices are falling, people can't get mortgages, banks are less likely to lend at the moment, Help to Buy is gone, the stamp duty holiday is over. So you have the situation, particularly for this house builder.
That could change though, couldn't it? Because we've been looking at A, house prices, but B, also lending rates. And there seems to be almost a race to the bottom, but not to the bottom, but at least for a lot of the lenders reducing their rates quite rapidly.
Well, it's market capitalism, isn't it? Because it's okay. So it's really quite simple. So you have the Bank of England base rate, right, which currently stands at 5.25%.
Yeah.
Markets think it'll hit 5.9%. In reality, rounding up around 6% will be the terminal rate.
Yeah.
Maybe early next year. I think it might go a little bit higher than that. But if you take the 6% base rate, then I'm trying to think of the words. So if you're taking out a 5-year mortgage now, the bank might offer you, say, 5.5%, because the bank that is lending to you is operating under the assumption that rates will come down to, say, 3 or 4% over the next couple of years. And the margin, essentially, between what the Bank of England base rate is and what they lend out to you is the bank's profit. Now, obviously, if you're a bank, you're going to want to make the most profit you can. So you're going to want to charge your mortgages as high as possible against the Bank of England base rate. However, obviously, there's a competition. And particularly when the mortgage rates are so high, the number one thing that customers are looking at, especially in a cost of living crisis, is who's got the cheapest mortgage. And who's got the cheapest mortgage? So obviously, you've now got this situation where banks have a high base rate for the Base of England, from the Bank of England. So they're struggling to lend out money because they have to ensure that people can pay it back. They also have to compete with each other to ensure that they get enough customers, because if they don't compete with each other or they're the most expensive, they're not going to get very much custom. But then on top of that, and I'm not sure if you saw what came out of Italy with the new bank windfall tax.
I didn't know.
No. Oh, okay. Well, essentially,
we like tangents, Charlie. So we're going from house builders to.
Well, Italy decided to impose. You'd like the North Sea energy tax in the UK. Italy decided to impose a windfall tax on certain profits related to higher interest rates on the banks, right? Now, this is really important because when you consider a Lloyds, for example, which is, through its various brand portfolio, is the largest mortgage lender in the country. I think there's £300 billion roughly of open mortgage lending on its book. You have to consider that not only is Lloyds competing against other mortgage providers in the market, and they're also having to be careful with who they lend to, restricting further the pool of customers. You also have the government essentially on its back to ensure that they're not making too much profits, that they're helping people along. You're seeing this in the media all the time, politicians saying, well, the banks have to, make sure their profits and their net interest margins aren't too high. And if they do go too high, then you have the threat of a windfall tax. So when you look at Lloyds, for example, and its share price is traded in a 40 to 50p range for a long period of time, the reason for that is that if the share price went over 50p or the dividend got too high, there is a strong chance that politicians would get involved and impose a tax. And therefore, it puts an artificial ceiling on how high Lloyds shares can go.
Right, I'm with you. And so what? So they did this in Italy as well then?
They did this in Italy, and it caused the bank shares to collapse. And then the Italians panicked, so they rewired the tax so it wasn't so draconian. But it kind of came out of nowhere. And so you've got this risk factor for UK bank or any other banks, especially after Silicon Valley Bank collapsed in Credit Suisse. But then on top of this, you've got this high interest rate environment where you'd think they'd make loads of money, but actually there's huge market competition, there's political pressure. You're less able to lend out to customers because obviously not everybody now can afford to meet these higher mortgage rates, even as house prices fall. Now, what's really interesting about this, and I don't need to do the calculations because people cleverer than me have done them, but the key thing to understand is that when interest rates are kind of below 2%, banks don't make much money because the value of money is quite low. When interest rates were above about 4.5%, because you can lend to less people because fewer people qualify for loans because they can't afford to pay it back, their profits are kind of squeezed as well. So the ideal interest rates are around 3 to 4%, which is where most analysts consider interest rates might be in sort of 2 to 3 years' time and then stay there for a long time. So while Lloyds, or UK banks in general, their share prices are depressed. And again, this is not financial advice, but if you're a long-term investor and you're looking for a dividend stock, Lloyds pays out a 6% dividend at the moment. The share price is at 42p, which is towards the bottom of the range it's been stuck in for a couple of years. And when the interest rates start to fall, paradoxically, Lloyds is going to make more money because even though you think they would make more money with higher interest rates, they don't because they have less customers and more competition.
Interesting.
And obviously that political stress.
Yeah.
This is just my view. Others will have a different opinion on it. But I think that when you have a cost of living crisis and you've had furlough and energy support and you've had help out and windfall taxes on the North Sea energy and so on and so forth, and you've got a government running out of money and people, a lot of people in this country with like severe financial stress. The Bank of England came out with a report saying that half of privately owned companies in the country could be in financial distress by this time next year.
Wow.
Because of rising interest rates.
Yeah.
It's quite easy to see a situation where the government might go, right, we're going to impose a windfall tax while interest rates are high until they drop down, in the same way as they said we'll impose a windfall tax on energy while energy prices are high until they drop down.
Yeah.
Whether that happens, I don't know, but I think it accounts for a lot of the reason why the Lloyds share price in particular is so low, because unlike, say, Barclays with its investment decision or HSBC, which is all over the world, Lloyds only has domestic UK operations. So it's really exposed to the UK economy and, for example, the rising risk of mortgage default, but also it has that political risk. In the same way as, for example, I invest a lot into exploratory stage mining companies in Africa, right? And if that mine in that one African country decides to change the law or something goes wrong politically, then my investment is shot. It's exactly the same for Lloyds, even though the UK is a tier 1 jurisdiction and there's no real political risk. There is a risk of windfall taxes that can smack investors out of the blue, like they did in Italy.
Yeah, exactly. I mean, I know Dr. James Fox, who's one of our stock analysts on the website, he was suggesting that Lloyds share price is trading at its lowest point in 2023, continues to decline, and concerns relating to the macroeconomic climate. So it could be a buying opportunity for long-term investors.
Yeah,
I'm going to say not financial advice, so that's 1-1, I think.
Indeed.
What about
I broadly agree with him. Yeah, I mean that sums up my thoughts as well.
That's kind of the summary of what you were just saying, wasn't it? So,
yeah.
So what about the FTSE 100 insurers then?
Yeah, sure.
What about legal and general?
So
we're talking about them.
Legal and general is, as you may know, dividend royalty. You would struggle to find somebody, a UK investor, of FTSE 100 stocks who didn't have legal and general somewhere in their portfolio. The reason for this is they pay a really, really reliable dividend that ranges between kind of 6 and 9% and have done for years. Now, the key to this is the Solvency II coverage ratio, which is the critical measure in insurance. Their coverage ratio is 230%, which is up from 212% last year. It's a £9.2 billion surplus. They have a dividend policy whereby they're going to increase the dividend by 5% a year up till 2024, and I suspect that'll be extended. There's a good chance there's going to be share buybacks as well. So none of this is financial advice, but the basic point of Legal & General is that where, for example, you can put your money at the moment into a savings account or a cash ISA for say 4 or 5% returns. If you buy Legal & General shares and you're holding for a long period of time, and again, this is not financial advice, but if you do
Charlie,
that,
that's 3 now. Come on.
I know. But we're talking about individual stocks, so you've got to get them in there.
Yeah.
But I mean, the basic thing is, yes, assets under management have fallen a little bit, but they're going to because you've got higher interest rate environment. But the company, even with the CEO retiring at the end of the year, the company is extremely well run, and you're getting a higher return if you buy Legal & General shares than you would in a savings account with very limited extra risk, given the Solvency II coverage ratio and the fact they operate in insurance.
Yeah.
Now, obviously to some people, that the alternative to Legal & General is Aviva, and many people who buy Legal & General shares also buy Aviva shares in equal measure because it's the other general insurer that's really, really popular. And their results were quite interesting because their operating profit rose by 8%, but the Solvency II coverage ratio fell by 10% to 202%. And what this means is that even though they're getting more profitable, their defensiveness and their ability to cover the dividend, even though the dividend rose, is slightly weaker.
Yeah.
Now, the reason for this, and this is just my opinion, but the CEO, Amanda Blanc, who's been there a couple of years, implemented a really, really good turnaround plan. She's now beat profit expectations. But the problem is she's done this by creating efficiencies in the company. And now, as an insurer, there's so much regulatory baggage that there's only so much efficiency you can put into a company. Everyone who works there has a job that actually needs doing.
Yeah.
So she's going to struggle to make it more efficient than what it is. Having said that, one of the bright spots and the really popular, what's making Aviva really popular or not, depending on your perspective, is sales of private health insurance. They've gone up 58% to £86 million.
That does not surprise me in the slightest with the state of the NHS. It's
Simon, 170,000 extra health insurance customers over the past year alone. People signing up to digital GP, which, you don't have to visit your GP to get things like sick notes.
Yeah.
But my perspective on it is yes, it's essential. The problem is that obviously the same private doctors who will see you with Aviva are also either ex-NHS doctors or NHS doctors doing work on the side. It's not like there's this magical pool of extra doctors. And I don't want to get into politics because
let's not do politics with the NHS.
No, whatever we say, we'll get, bricks and hellfire thrown at us. But the basic point is Aviva is doing very well out of the NHS struggles.
Yeah.
And all I would say about that, given that their Solvency II coverage ratio has fallen, even though they've hiked the dividend, is that if you have, and this is not political at all, but if you have a government that decides to invest a lot more into the NHS, whether this one or the next one at any point, that demand for private health coverage will fall with the NHS as the NHS improves. And therefore, Aviva to me looks like a less solid choice if you're thinking along the very long term. If you're buying a share to hold for like 40 years rather than sort of the next 5.
Okay. Thanks for that insight. I'm looking at Admiral as well. And interestingly, I saw this because I actually was an Admiral motor vehicle insurance customer. They lost. Yeah, I was, yeah. So I got a renewal policy through, and it was a lot. And I kind of said, no, come on. So I got a different quote. This is actually for my camper van. So I got another quote through from another company, and it was 50% less than the renewal quote from Admiral. Now, I spoke to Admiral about this, and they said, let us try and beat that quote you've got. And I just said, with all due respect, you've got no chance. Now, they lost 380,000 vehicles from their books, and yet investor reaction was positive because you'd expect that to be a red day, didn't you? But it wasn't.
You would. It's a dividend stock, and it is a dividend stock. It's not a growth company in most people's minds. I know other people will disagree, but it's in that kind of same segment as Legal & General and Aviva. And where I would say Legal & General kind of edges out Aviva, again, not financial advice. Admiral is it's in its different class. The price hikes were around 40%, right? So they hiked the price by 40%. They lost 380,000 vehicles, but their insurance revenue jumped by 14%, okay? Yeah. And then the pre-tax profit went up by 4%. So what that's telling you is that they managed to retain enough customers to be profitable.
Yeah.
But your problem is, okay, so there's a couple of things. Why the share price rose, I think first is that they sorted out a lot of long-standing issues that have been irritating investors for a long period of time. So employee share schemes, setting aside money for IFRS 17 accounting standards, business development costs, write-offs to the pioneer business, stuff that should have been done a long time ago.
Yeah.
And, they cut the dividend in order to make that happen. But actually looking forward as an investor, you go, okay, finally. Do you know, like, I'm self-employed, obviously you're self-employed, and there's, when you have a lot of accounting stuff to do, it builds up in the back of your head. It's the same for investors. There's always some paperwork due, and then once it's all over with, it's painful. And, if I spend a couple of days doing like accounting stuff or whatever, that's days that I'm not actually earning any income. But then once it's over, it sets you up so much better for the future. And that's what I think Admiral have done. Now, the problem they're going to have is that, yes, some customers this year will have just, gone, okay, click the box, we'll sign up, we'll pay 40% more, whatever. But their problem is that next year when they come to renew their quotes, will those same customers continue to, use Admiral or not?
Well, it won't be me, that's for sure.
No, it won't be me either. And the problem they have as well is, again, it's intervention on a regulatory side.
Yeah.
Is it reasonable to increase your prices by 40% when all of your competitors, or many of your competitors, are increasing them by a much lower amount? Is it reasonable to do that? And obviously they're a private business and they can do what they want. But at the same time, if you drive a car in this country, it is a legal requirement to have car insurance. And many, many, many people don't check quotes. They just continue with whatever provider they have. So,
well, that's just lazy, isn't it?
Well, it is lazy, but you say it's lazy, but actually plenty of people, I'll give you an example. I have life insurance with Legal & General, interestingly. And I think it's £20 a month or whatever. And I took it out when my first son was born.
Yeah, but you're only in your 30s, aren't you?
Well, yeah, but I'll tell you this. I have never, it's probably more for you, Simon, if you haven't, but I have never looked, sorry, but I've never looked at renewal quotes, or when the policy runs out, I just renew it. I've never looked, I've never cared. I just think, well, if it's a few pounds more or less, that's fine. Whereas with car insurance, when it can run into, hundreds or thousands a year, then it's very different. But I do think there's a large number of people in this country who do not have, a financial education, and therefore just, they continue with whatever mortgage provider they take their first mortgage out with, rather than comparing. They pick an energy provider, and that's the one they go with forever. They get car insurance, and that's the one they stick with. And because we work in
Well, it's a sweeping statement, though, isn't it? I mean, I think a lot of people are savvy. They you've got your money saving experts. You've got go compare the market, all that. I think there is a general awareness there that people do need to shop around. But you're right. There will be a proportion of the population
not
that just
the majority.
Not the majority. No.
Not the majority, or even it doesn't even need to be a big minority. But even if you say 15-20% of the population, that's a large number of customers that essentially can get ripped.
And they're holding the share prices up of L&G and
of course they are. Yeah. Well, I full disclosure, I have Legal & General shares. I don't think it's not a particularly risky stock, because in my SIP it sits there and provides a dividend every year, and so I pay slightly more for my insurance. I'm not too stressed because I'm just paying myself. That's the way I look at it. No problem at all.
All right. Well, here's a segue for you. A question.
Yeah,
so, out of the FTSE 100 companies, how many pay dividends?
The dividends is I don't know the exact number, actually, but dividends I know for the FTSE 100 companies is the name of the game, because they're mostly mature companies, which, have finished their growth and,
I'm going to Google it.
Please do. I suspect it'll be the vast majority. Most of them aren't looking to grow more. Most of them are looking to just pay out a dividend. And we're going to talk a bit about the S&P 500 to compare and see why that is the case.
Oh, I've got an answer. I've got an answer, Charlie.
Is that up to date? It changes on a regular, but tell me.
It's actually come up. The top Google result is from AJ Bell, dividend dashboard, and it says 97 FTSE 100 firms are expected to pay a dividend in 2022. So it's not up to date. SEO opportunity for me there too.
There, right there. Yeah. I was about to say, I was going to say it off air, but no. I think, but this is the thing, isn't it? It's if you look at Persimmon, for example, right?
Oh yes, Persimmon. We need to talk about them, don't we?
We do, but it's really interesting because we were talking about how Marks and Spencer have gone up.
Yeah.
Persimmon have gone down, or are most likely going down. Now, Persimmon in 2022, I think their dividend yield, if you Googled it, was generally around sort of 15, 16%. It was ridiculously high because you had high house prices and really high demand for houses. They could achieve really good results. Had a stamp duty holiday, you had Help to Buy, everything was going well for them. And now their dividend has crashed to about 2%. And it's because of this poor housing market. So one of the key things, and again, this is not financial advice, but when you're looking at the best, or the highest yielding FTSE 100 stock, the yield is based on past performance. So you look at the share price, and then you look at the dividend, for example, over the past year, and then you use those numbers to figure out how high the yield is.
Yeah.
But it doesn't take into account, when you're investing, you're actually looking at the next year. So you're trying to figure out what the dividend will be a year from now.
Yeah.
With an insurer like Legal & General, because people just pay their insurance every month, it's really defensive. So you can be pretty confident you're going to get that dividend. With something like housing, which is cyclical, house prices come up and down, mortgage rates come up and down, interest rates come up and down. It's not the case. You tend to have years where you get really high dividends and years where you get really low dividends. So if you're buying Persimmon shares now, I think the share price has fallen by roughly 50% since its height over the past year or two. So what you're actually doing is it's meant to be a dividend stock, but if you were to invest in it, you're investing for the capital gains because you're hoping that when the mortgage market starts to recover, the housing prices start to recover a little bit, Persimmon will then get more profitable, the share price will rise until the point where they feel they can start paying out those massive dividends again.
Yeah.
Now, the thing is, it's it's becoming a FTSE 250 company. Crest Nicholson, which is a fellow FTSE 250 company, which is also a house builder, reported really, really poor results the other day.
Yeah.
That's all their share price essentially tanked. And this is the outlook for house builders. But having said that, this is the thing, it's cyclical. So if you look at cyclical stocks rather than defensive stocks, you can get really, really good dividends in the good years and relatively poor dividends in the bad years. And the idea is that in the bad years, when the share price is really depressed, you buy more of the shares with the dividends that were paid out in the good years. Anyway, that's the idea. And then when you get back to the good years again, you get a higher dividend again.
Not financial advice, though.
Not financial advice.
Excellent. I've got it.
Wonderful. Wonderful.
Good stuff. We're going off piece, which I don't mind. We were going to talk...
Story of our lives, right?
Yeah, indeed. So why don't we talk about the FTSE 100 versus the S&P 500? I'm sure our listeners, all three of them, will understand these two different indexes, one over there and one here.
Sure.
Charlie Carman, our other stock analyst at large, he talks about, will the FTSE 100 deliver stronger future returns than the S&P 500? What's your view on that, Charlie?
Well, there's a few misconceptions to clear up first. The first thing is that when you talk about the FTSE 100, you're talking about the 100 largest companies in the UK by market cap. And even though there are some of those companies, like AstraZeneca, for example, or Shell, which have a slightly outsized influence on the index, all 100 companies are relevant to how it performs. When you look at the S&P 500, the majority of the index is dominated, because it's weighted by market capitalization, the majority of its performance is dominated by these larger blue chip tech stocks. So Apple, Tesla, Microsoft, Amazon. You know all the big names, don't you? You know?
Yeah.
So the key thing to understand is what you're saying is, are these dividend stocks of the FTSE 100 potentially going to outperform the giant tech stocks in the United States? Now, in 2022, when I looked at this similar question, I argued correctly as it turned out. Again, this is not financial advice, and part of investing is luck as well. But I said rising interest rates are going to see the FTSE 100 outperform the S&P 500 because tech stocks in the US rely on cheap monetary policy to grow. Now, obviously interest rates rose, but we're close to a peak of interest rates at the moment. And the question is, with interest rates peaking and potentially falling over the next year or slightly falling over the next year, are these tech stocks going to expand and grow? Are they going to provide capital gains faster than the FTSE 100 can pay out dividends? Now, over the longer term, the data is pretty clear. If you look between 1957, when the modern S&P 500 started, and present day, it's paid out between 10 and 11% per year, average return every year if you average it out. Obviously, there's been years where you've seen bigger falls, and years where you've seen bigger rises. But if you've invested since 1957, you see a 10 or 11% return. The FTSE 100, and I think it's probably fair to do it from, say, because the stocks change quite often. If you look from, say, 2010, between 2010 and 2019, including dividends, you're looking at sort of an 8 to 8.5% return. So the S&P 500 over the longer term has historically outperformed the FTSE, but we're now in this unique situation where you have higher interest rates. Money is harder to come by, so growing is more difficult. When you're a FTSE 100 company and you're done with your growth and you're paying out dividends and you're generating profits, that's not a problem. With your S&P 500 company, that is an issue. And key to this, I think, is whether there's going to be a soft landing in the US. Now, inflation is riding around 3%, which is 1% over the target. But when you look at how interest rates have risen, the general rule of thumb is it takes 18 months for the first interest rate rise to completely feed into the economic system. So the US started interest rate rises in, I believe, January 2022. I know in the UK it was December 2021. So it's only in the past couple of months that we felt the full effects of those interest rate rises today. This is where it gets complex, because if the market is forward-looking and you're saying, okay, we're near the top of interest rate rises and they're going to start falling over the next couple of years, that would be good for the S&P 500. But history shows that when interest rates start to get cut, the only reason why is because the economy is slowing down.
Yeah.
Because the reason you're putting the rates up in the first place is to slow down the economy. And if the economy slows down, then growing the company is more difficult. So I think there is a good argument to be made that the FTSE will continue to just deliver its plodding dividends every year, right, reliably. And the S&P 500 over the next year will, they may match it. They may come slightly under or over, but I think there's a good chance that the FTSE will beat it. But beyond that, and again, this is not financial advice, and the general idea.
The general idea is one.
Well, let's see. The tech stocks in the US are higher risk, higher reward, right? If you're buying a FTSE 100 index tracker, it's unless something truly awful happens, you've got to bear in mind 82% of the corporate revenue from FTSE 100 companies comes from overseas. They're global companies. They pay out their dividends reliably. You're going to get that 4% return unless something really, really bad happens.
Yeah.
With the US stocks, you could get a much higher return, but you might not. And I think the key thing is when you're comparing these two indices, generally you want to buy more S&P 500 index and invest in those tech shares. But at the moment, the risk premium of doing that is quite high compared to the extra return of, I was talking about over the past few decades, the S&P 500 returns a couple of percent more. Is that couple of percent more worth it over, say, the next 1 or 2 years when the chance of something really bad happening is quite high? If you look at 2022, many of, the S&P 500 fell into a bear market at one point, which is where it lost 20% of its value over the year. And it's now recovered that, or mostly recovered that. But that doesn't mean it can't happen again. And I think there's a good chance that it will. If you're looking at the very long term for investing, then S&P 500 is probably going to beat the FTSE 100. But if you're looking over the next 2 or 3 years, that may not be the case. And as a and I'll say this quite simply, in my SIP, what I tend to do is I go for S&P 500 tracker. I also pick individual dividend stocks in the FTSE 100 that provide a better dividend return. And like Legal & General or Aviva, that may, those individual stocks may deliver a better return than the US side at the moment. But it's as I think it was Charlie Carman wanted to, you wrote that initial article, his initial analysis.
Yeah.
And it's very difficult to know what's going to happen over the next year. But the vast majority of UK investors will be, buying shares, or indices on both sides of the Atlantic because it makes sense. And the last thing I would end with is that if you're looking specifically for dividends, there, I think it's, and again, this is not advice, but I think it's BlackRock. There's a couple of them that look at the FTSE 350, which is the FTSE 100 and FTSE 250 put together. Mm-hmm. And every month they find they analyze the market and they find the 50 shares with the highest yield. And then you buy an index tracker going for those top 50 dividend yielding stocks. They also look at other metrics like how reliable the dividend is, for example. And then that index tracker, I think, could outperform the S&P 500. But you don't know.
You don't
Nobody knows.
Nobody knows. None of this is advice, including the contributions of the companies and the indexes that you invested in your SIP. I just need to get that in there as well. It's very interesting, though. Very, very interesting. So you said interesting cross between an S&P index that you have and individual FTSE 100 shares in there as well. So that's super interesting. That's great, Charlie.
I will finish it off here, but I think you've got to remember with the FTSE 100 companies, they've finished growing, right? So they're not going to grow more. Mostly they're paying out the dividends. That's fine. The S&P 500, the reason I go down the tracker approach is because while at the moment Apple and Microsoft and Tesla are the ones, making all the money, all of those companies were penny shares at one point in the not too distant past,
that's
within
very true.
our lifetimes. Yeah. And therefore having shares in the smaller ones as they grow makes a lot of sense to me.
Yeah, indeed. Well, thank you, Charlie, for that. That was an interesting insight into what's been happening on the FTSE 100 this week. So potentially Persimmon out, demoted. Marks and Spencer's more than likely in. And we look forward to seeing your weekly roundup on Friday, Saturday, tomorrow or Saturday this week. That was brilliant, Charlie. Thank you very much.
Excellent. Well, I enjoyed it. I love chatting to you, Simon, as you know. Always entertaining.
Brilliant. Well, let's cue the music and we'll get on to the next one next time. See you later, guys. Thank you for listening to That Investing Podcast, brought to you by the team at Investing Reviews. Check out our latest stock market news and analysis at investingreviews.co.uk. You can also find us on Twitter and LinkedIn. Just search for Investing Reviews.